What? Christmas is here in just a week? You got to be kidding me. Oh, man. And TradeSmith is supposed to come out on Christmas? Well, you know what? Santa is going to bring you a TradeSmith next week. I love doing this newsletter. I'm going to do it on Christmas Day just for you. So what the heck? Come on, let's make some money while it's this holiday season. All right, and of course, this makes me feel cheerful every time I read it. It's just like I get giggles. All right, but let's get into the market. Come on, what can I say? So we still have a very good bull market, as I've been leading you all these weeks, months. Look at what happened on Friday. Great price action. But the purple predictor, which had been very, very bullish, is not so bullish anymore. It's not bearish, don't get me wrong, but it's not that bullish anymore. We're starting to set up maybe for a little dip in early January of a couple percent. But right now, we're still in this incredible bullish Christmas season. The so-called Santa Claus rally should carry us right through to the end of the year. Dow Jones, look at the little green line up at the top. That's DI plus. The little red line is DI minus. You can see the DI plus shows buying pressure. The red line shows selling pressure. And you can see that the buying pressure is way stronger than the selling pressure. So that's driving the Dow Jones to new highs. Nasdaq, same thing. Only here, the purple predictor is a little bit more bullish, and we're making new all-time highs. So everything pretty clear right now. Seasonality, bullish. We'd have to break below that red line there around a little above 144 on the IWM to turn me bullish. So right now, all of my winning trades, they're double size. They're double size. I'm making double money. Come on, you got to love that. Seasonal patterns remain bullish until really January. I'll start showing that chart coming up soon. Now, the yield curve. Here we are at the very, 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 very peak of this chart. And what happens is this is a 1 year forward indicator, but it really works at extremes. We're not at extremes yet. If we look down in the lower right-hand corner, we can see that the yield curve has flattened. This is called flattening down to 105. That's not a danger zone, but we're sort of getting closer and closer to a danger zone. So what's going to happen is that this yield curve, as it moves down from a year ago, and that's a 1 year leading indicator, is going to put a cap on prices in the coming year. We're not going to see an up 35% year. We're going to see a year that struggles and goes forward 2 steps and back 1 step because this yield curve is coming down. Asset allocation, just chop, chop, chop at a high level, showing money is still moving out of the bond market. Stock market riskdicator. I've been highlighting this the last little while. What this shows is that people are still being defensive. They don't believe this bull market. And they're saying, you know what? Let's just back off a bit. Let's buy a little bit more conservative things rather than risky things. And this is kind of one of those things that it's not saying that we should sell the stock market, but it is saying that this is going to be a struggling bull market, a grinding bull market, not an explosive bull market. Global shares pop to new highs, but I think the action's in the U.S. right now, so I'm not focusing on overseas. Bonds move to new highs here, new multi-month highs, I should say. And I'm going to show you my indicators in just a second here. And of course, fully paid up members, I'm going to show you some more indicators. But notice the purple predictor is bullish. This is the highest close since the beginning of September. This looks like we might see lower bond prices. But Courtney, isn't the Fed raising interest rates? Yes. They are raising interest rates, but what they're raising are the Fed funds rate, which matures in 90 days. These are 20-year bonds, and they're very excited about a number of different things, causing them to go up in price, meaning interest rates go down. At the same time, the Fed is raising short-term interest rates. And by the way, that's why, let me go back to it, the yield curve is coming down. The yield curve is the difference between 90-day treasury bills and 30-year bonds. And so here what we see is that the Fed's raising interest rates, But at the same time, the long end of the yield curve is coming down, and that's what's making these interest rate differential narrow so much. All right, let me catch up to where I was. Okay, let's look at our indicators. Now, this was interesting. I mentioned this last week about how, let's look at these four lines here. The green line is the 20-year Treasury note yield. You can see it's pretty much flat, but this is the price of gold, which is a leading indicator of the bond yield. This is the 10-year Treasury in Germany, a big competitor. And even the CRB has started to turn down. All three indicators are suggesting we're going to see lower interest rates in the bond market. Of course, I just showed you it's in a bull market, which means lower interest rates. Remember, when bonds go up, interest rates go down. So here we finally got a very clear picture that we're going to see a bull market in bonds and lower long-term interest rates. The dollar. Now, if interest rates go down, usually the dollar starts to crack, and you can see it's starting to crack here, and we're putting in a big head and shoulders top. And I think that this means that we're about ready to see another collapse in the U.S. dollar. Now, if the U.S. dollar goes down, then gold should go up, and it certainly is. And remember, all through November, I kept saying, why is gold so weak? And finally, it crapped out. But now we're starting to see some more bullish indicators. Let's take a look over here at our indicators. Down here at the bottom, the yen had been collapsing, but it's shown a little bit of strength. Too early to really say if this is going to move higher. We had the CRB, which still going down, but it's flattening. The momentum is not as bad. Same thing here in the euro, kind of going sideways over the last week or so. So we're taking some of the pressure off of gold. Not enough that I want to get on the long side. I'd rather be short the dollar if it breaks those lows than long gold at this point. Oil, I think we've pretty well reached our high. I said we might get up into 60. Now we're kind of chopping. We might be setting up a little head and shoulders top here. So all in all, I'd rather be a little bit on the bearish side, but quite frankly, I'm not trading oil right now. All right, that's it for all you freebies. Love having you around. Please tune in, tell your friends, etc., etc. But of course, if you want to be with the cool kids, you should subscribe at that link up at the top. All right, fully paid up members. I got some pretty exciting stuff coming up here, so just hang in there for just a second.